There are few experiences in the stock market more universally painful and frustrating than being forced out of a position at a low, only to watch in disbelief as the price immediately reverses and surges upward without you. For most, this event is dismissed as simple bad luck, a random sting of the market, or proof that the game is hopelessly rigged. But for Richard Wyckoff, this was not a random event at all. He recognized it as a frequent, deliberate, and most importantly, an identifiable maneuver. He saw that these false breakouts to the downside, which he termed springs and shakeouts, were not acts of chaos, but rather calculated tools used by the market's most informed operators, the Composite Man, to mislead the public and eliminate competition just before a major advance was set to begin. He understood that these deceptive moves, while ruinous for the uninformed, offered a golden opportunity for the astute analyst who knew what to look for. This video will pull back the curtain on these powerful maneuvers. We will explore the manipulative psychology behind them and provide a detailed step-by-step guide to the specific price and volume characteristics Wyckoff used to identify these bear traps, turning what was once a source of frustration into a signal of immense opportunity. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To understand the mechanics of the shakeout, one must first understand the mind of the entity that engineers it. Wyckoff's most powerful interpretive concept was that of the Composite Man, a single imaginary character who represents the amalgamation of all the shrewdest, most well-informed minds in the market. He is the sum of the large operators, the corporate insiders, the syndicate managers, and the skilled floor traders. While these individuals do not act in a formal conspiracy, their deep understanding of value and market mechanics leads them to act in a similar logical manner. The Composite Man is the ultimate professional. He is cool, patient, and calculating. He operates without emotion, viewing the market not as a casino but as a grand strategic campaign. His business model is simple: to accumulate a large line of shares at the lowest possible prices when the public is pessimistic, and to distribute those same shares at the highest possible prices when the public is euphoric. He is a master of mass psychology, and he understands the public's predictable reactions to fear and greed better than they understand themselves. He knows that the average man buys on hope, sells on fear, and is consistently wrong at the major turning points. The shakeout is one of his primary tools, a deliberate maneuver designed to prey on these predictable emotions to achieve his business objectives. To the Wyckoff analyst, therefore, a shakeout is not a personal attack. It is simply the Composite Man going about his work in the most efficient way possible. With the identity of the hunter established, we must now examine the reasons for the hunt. Why does the Composite Man, after a long and patient campaign of absorbing shares in an accumulation trading range, engage in a final, terrifying maneuver designed to drive the price to a new low? The reasons are not malicious, but they are intensely practical and threefold. The first and most important objective is to eliminate future competition. Wyckoff taught that the greatest obstacle to a successful markup campaign is the presence of a large floating supply of stock. This is the portion of a company's shares that is in the hands of the public and short-term traders, the weak hands. After a stock has been in an accumulation range for some time, many of these traders may have also recognized its potential and taken long positions. While they may be correct in their analysis, they represent a threat to the Composite Man. If he begins the markup while these weak hands are still in the market, they will be tempted to sell on the first small rally to either get out, even, if they bought near the top of the range, or to take a quick, nervous profit. This selling or overhead supply acts as a brake on the advance. It forces the Composite Man to absorb their shares at higher and higher prices, increasing the cost and effort of his campaign. The shakeout is his solution to this problem. It is a preventative measure, a final, thorough cleansing of the market before the real move begins. By engineering a sharp, frightening drop below a well-defined support level, he creates a powerful illusion of weakness. This move is designed to convince the remaining weak hands that their judgment was wrong and that the stock is about to begin a new, severe decline. This triggers a final wave of selling from these holders, allowing the Composite Man to absorb their shares at the bottom. He is, in effect, removing the potential for future supply before it can impede his advance. He is clearing the path of least resistance, ensuring that when he begins the markup, there will be as few sellers above him as possible. The second objective of the shakeout is to create liquidity by hunting for stop-loss orders. The Composite Man, by the end of his accumulation campaign, needs to acquire a very large number of shares. But in a quiet, dull market, finding willing sellers without bidding the price up can be difficult. He knows, however, that there is a large, concentrated pool of shares available for purchase at one specific location, just below the support line of the trading range. This is where the majority of traders, having been taught to place your stop below the low, have placed their protective stop-loss orders. These stop-loss orders are a gift to the large operator. They are a standing army of automatic sell orders just waiting to be triggered. The shakeout is the mechanism for triggering them. The Composite Man can sell a relatively small number of shares to aggressively drive the price down through the support level. This initial selling triggers the first layer of stops. Those sales, in turn, drive the price lower, triggering the next layer of stops, creating a cascading effect. This sudden manufactured wave of selling creates a huge amount of liquidity, a flood of shares for sale, at the very moment the Composite Man wishes to do his heaviest buying. He can then step in and absorb this entire supply, not as a panicked seller, but as a calm, deliberate buyer. From his perspective, it is not a malicious act of hunting individual traders. It is a highly efficient business transaction. It allows him to complete his inventory acquisition at the lowest possible cost, just before he begins to mark up the price of his goods. The third and final objective of the shakeout is to serve as a definitive final test of the remaining supply. Before the Composite Man commits the immense capital and effort required to engineer a major markup campaign, he wants to be as certain as possible that the significant selling pressure has been completely removed from the market. The shakeout is his final reconnaissance mission, his ultimate test of the market's condition. By pushing the price down into new, vulnerable territory below the established support, he is essentially asking the market a question. Are there any more large sellers left? He then carefully observes the market's response to this probe. If his probe is met with a torrent of new, heavy, and sustained selling from other large interests, he knows that his work is not yet done. He will recognize that his accumulation was incomplete, and he will likely withdraw his support and allow the stock to seek a lower level where he may begin the entire process again. However, if his probe below support is met with a conspicuous lack of selling, if the volume is light and the price refuses to decline further, he receives his ultimate confirmation that the supply is exhausted. The market is sold out. This successful test gives him the confidence he needs to proceed. He has now confirmed that the path of least resistance is upward, and he can begin the markup phase with a very high degree of certainty that he will not be met with any significant campaign-derailing selling pressure. This final test is what turns the shakeout from a simple manipulative trick into a sophisticated and logical component of a much larger strategic plan. Having thoroughly explored the motives of the Composite Man, understanding why he engineers a shakeout to eliminate competition and absorb the final floating supply, we now transition from the psychological why to the practical how. How does the Wyckoff analyst, armed with this understanding, identify this complex and deceptive maneuver on a price chart as it unfolds in real time? This is not a matter of guesswork. It is a science of diagnosis based on a logical analysis of the market's symptoms. Wyckoff provided a clear framework for this diagnosis, focusing on 4 critical elements: the context in which the maneuver occurs, the character of the price action, the story told by the volume, and finally, the all-important confirmation. This section is a deep dive into the anatomy of the trap, a step-by-step guide to recognizing the shakeout through the lens of a professional operator. The first and most important principle in identifying a shakeout is context. A shakeout is not merely any sharp drop below a support level. Its validity as a bullish signal is entirely dependent on where and when it occurs in the market cycle. A true spring or shakeout can only happen in one specific location, at the end of a well-defined and prolonged accumulation trading range. This is a non-negotiable prerequisite. The analyst must have already gathered substantial evidence that a period of accumulation has been taking place. This evidence includes the prior stopping of a downtrend with a selling climax, the establishment of a trading range, and the observation of supply being absorbed within that range, as indicated by diminishing volume on reactions. A price break below a support level in any other context has a completely different and often bearish meaning. If a stock has been in a clear downtrend and experiences a brief pause before breaking a temporary support level, this is simply a continuation of the markdown. If a stock has been in a distribution trading range at the top of a long advance and breaks its support line, this is a fall through the ice, a major sell signal. To mistake either of these for a bullish shakeout would be a disastrous error. Therefore, the Wyckoff analyst must first establish the proper context. He must be able to say with a high degree of confidence, "The evidence suggests this stock is in the late stages of accumulation, and the Composite Man is likely preparing for a markup." Only then can he begin to interpret a sharp drop below support as a potential shakeout, the final act of preparation. With the proper context established, the analyst can then turn his attention to the price action itself. The price movement of a shakeout is designed to be terrifying. It is typically a sharp, rapid, and decisive thrust below a clear and obvious support level, a level that many traders are watching and where many stop-loss orders are clustered. The move is engineered to look as convincing as possible, to create the powerful illusion that the period of stability is over and that the stock is beginning a new, severe decline. Wyckoff used the terms spring and shakeout to describe this action. A spring typically refers to a quicker, shorter duration move, often lasting only 1 or 2 days, where the price pokes just below the support line before snapping back. A shakeout can be a more severe and prolonged event, where the price drops further and may stay below the old support level for a longer period before recovering. Despite this difference in magnitude, the underlying purpose and the analytical principles remain exactly the same. The key characteristic of the price action is its violation of a support level that had previously held firm, often multiple times. This violation is what triggers the fear and the forced selling that the Composite Man desires. While the price action creates the illusion, the key evidence that reveals the true purpose of the move is found in the volume. The volume signature is the Wyckoff analyst's secret weapon. It allows him to see beneath the surface of the frightening price drop and understand the real balance of power between supply and demand. As we have discussed, Wyckoff identified 2 distinct types of volume signatures for a shakeout, each with a profoundly bullish implication. The first and most powerfully bullish signature is a shakeout on low volume. This is the Composite Man pushing on a door and finding it unlocked and completely unopposed. The price breaks below the support level, a point where one would expect to encounter a flood of stop-loss orders and panic selling, but instead the volume is conspicuously light, sometimes even lower than average. This is a direct and unambiguous message from the market. There is no more supply. It is proof positive that the sellers are gone. The Composite Man has successfully absorbed the available shares during the preceding accumulation, and this final probe into new low ground confirms that the market is sold out. This lack of selling pressure indicates that the path of least resistance is now definitively upward, and a markup is often imminent and can be very aggressive. The second and more common type of signature is a shakeout on high or climactic volume. In this scenario, the break below support does succeed in its mission of triggering a large number of stop-loss orders and inducing a final, convulsive wave of panic selling from the remaining weak hands. This appears on the chart as a very high volume bar. On the surface, this may look intensely bearish. However, The Wyckoff analyst interprets it through the lens of the law of effort versus result. The high volume is the effort of the sellers. The result is what happens to the price. If the price stops declining on this high volume and then begins to reverse, it is a clear sign of strength. It shows that the Composite Man was present and that his buying power was great enough to absorb the entirety of this final wave of selling without allowing the price to collapse further. The high volume represents the successful transfer of the last of the shares from the weakest possible hands into the strongest possible hands. This powerful absorption is the final act of the accumulation campaign. This leads to the final and most crucial element in the anatomy of the trap, the confirmation. The true secret to identifying a shakeout is not the price break itself, but the character of the price action that immediately follows. A genuine shakeout must be confirmed by a swift and decisive recovery. The price must not linger in the territory below the old support line. It must quickly reverse and climb back into the trading range, reclaiming the support level. This rapid recovery is the non-negotiable proof that the move below support was a false breakout. It proves that the buying power that appeared at the low was superior to the selling pressure. A price that breaks support and then stays down, or rallies feebly back to the underside of the support line only to be met with more selling, is not a shakeout. It is a genuine breakdown and the start of a new markdown phase. The confirmation, this quick reversal, is what transforms the shakeout from a moment of fear and danger into a moment of supreme opportunity for the analyst who can correctly interpret the evidence. Having meticulously dissected the psychology of the market predator and the technical anatomy of his trap, we arrive at the final and most empowering stage of our study. Knowledge in the stock market is power. Understanding the motives of the Composite Man and recognizing the distinct footprints of a shakeout as it appears on the chart elevates the analyst from the level of the uninformed public, who are the prey, to an entirely new level of perception. The final step is to transform this knowledge from a defensive shield into an offensive weapon. This section is dedicated to the practical application of this knowledge. It is a guide on how to not only avoid the trap, but to use the trap itself as a signal of supreme opportunity. This is how the Wyckoff analyst turns the tables, ceases to be the hunted, and learns to trade in harmony with the market's most powerful forces. To make this transition from a potential victim to a co-predator, the trader needs a clear, logical framework for decision-making. The emotional pressure at the moment a shakeout occurs is immense. The price action is terrifying, and the instinct to sell is overwhelming. A predefined, logical checklist is the tool that allows the analyst to overcome this fear and act with the cool objectivity of a professional. This is the mental framework a Wyckoff analyst uses to test the validity of a potential shakeout in real time. First, the analyst must confirm the context. Is the stock in a well-defined and prolonged accumulation trading range after a significant prior downtrend? Has there been prior evidence of supply being absorbed, such as a selling climax and a secondary test on low volume? Without this bullish context, any drop below support must be treated as genuine weakness. Second, he must observe the price action. Has there been a clear and decisive price penetration below the established support line of this trading range? The move should look convincing and should trigger the obvious danger point where most traders would place their stops. Third, he must analyze the volume. What is the character of the volume on this price break? Is it conspicuously low, providing the powerful evidence that supply has been exhausted? Or is it climactically high, and is the price refusing to fall further on that high volume, indicating that a massive absorption of the final wave of selling is taking place? Fourth, and most critically, he must wait for the confirmation. Has the price quickly and decisively rallied back above the old support level, reclaiming its position within the trading range? This is the non-negotiable proof that the move below support was a false one, and that the buying power that appeared at the low was superior to the selling pressure. If, and only if, the answer to all four of these questions is a definitive yes, has the analyst identified a high probability professional grade buying opportunity. The ability to act on this checklist requires a profound shift in mindset. This is perhaps the most difficult yet most important part of the entire process. The Wyckoff Method at its core is a contrarian approach. It requires the trader to buy when the news is at its worst, when the market is at its dullest, and, in the case of a shakeout, when the price action is at its most terrifying. The signal to buy with the greatest confidence often occurs at the very moment when every primal instinct is screaming to sell. To execute this strategy successfully, one must learn to trust the evidence of the chart over the emotions in one's gut. This is not reckless contrarianism. The Wyckoff analyst does not buy simply because there is panic. He buys because the evidence, the context of accumulation, the specific price action, the revealing volume signature, and the swift recovery, provides a logical, scientific reason to believe that the panic is manufactured, that a major turning point is at hand, and that the Composite Man is now on the buy side. It is an act of supreme discipline. It is the ability to see the strength that is hidden behind the illusion of weakness. It requires the trader to fully embrace Wyckoff's principle of independent judgment and to act in direct opposition to the sentiment of the crowd. It is the practice of buying the panic, not participating in it. With the correct mindset established and the checklist confirmed, we can now outline the precise Wyckoff strategy for trading a shakeout. This strategy is designed to maximize the potential reward while clearly defining and minimizing the risk. The first rule concerns the entry point. The most common mistake traders make is to buy too early. They may anticipate a shakeout and begin buying as the price is falling below support. This is the equivalent of trying to catch a falling knife. The Wyckoff method demands patience. The entry is never made during the break itself. The trader must wait for the confirmation. The trade should only be entered after the price has proven its strength by successfully rallying back above the old support line and re-establishing itself within the trading range. The ideal, lowest-risk entry point is often on the first small pullback after this recovery, a maneuver that tests the now reclaimed support line. This allows the trader to enter the market at the moment of least resistance, with the evidence of the Composite Man's support now clearly in his favor. The second rule concerns the placement of the stop-loss. The beauty of a trade based on a shakeout is that it provides an incredibly clear and logical place for the protective stop. The stop-loss order is placed just below the extreme low of the shakeout itself. The logic for this is perfect. The entire thesis for the trade is that the move below support was a false move and that the low of the shakeout represents the point where the Composite Man provided his ultimate support. Therefore, a subsequent decline that violates that extreme low would completely invalidate the entire thesis. It would prove that the initial downward thrust was, in fact, genuine weakness. By placing the stop at this point, the trader has a clearly defined and often very small initial risk. This leads to the final powerful advantage of this strategy, the exceptional risk versus reward ratio. Because the stop loss can be placed so close to the entry point, and because a successful shakeout often immediately precedes a major markup phase, these trades frequently offer enormous potential rewards for a very small initial risk. It is not uncommon for a shakeout trade to offer a potential profit that is 5, 10, or even 20 times greater than the distance to the stop. This aligns perfectly with Wyckoff's core business principle of only taking trades where the anticipated profit is at least 3 times the risk. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever, for anyone who wants to truly absorb the lessons we are discussing. This adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. The true power of the Wyckoff method is not in guessing the direction, but in reading the logic of the Composite Man's actions. Understanding the shakeout is the ultimate expression of this principle. It is not market noise. It is a logical, purposeful event with a clear anatomy and a specific objective. By learning to identify who is hunting the stops and why they are doing it, the Wyckoff analyst is able to transcend the fear that paralyzes the public. He learns to see the moment of maximum panic not as a threat, but as the Composite Man's final, powerful invitation to join him just before the real move begins. He stops being the prey and learns to trade in harmony with the predator, turning the trap into his single greatest opportunity.